You're watching Masters in Trading Live with Jonathan Rose.
Hey guys, it's Jonathan. Welcome back to Masters in Trading Live. We get on here every day the market's open, 11 o'clock a.m. Eastern Time, to go over the market. Once in a while, we'll share some trades. Today, 4 topics. QQQs, after NVIDIA. So quiet. What's going on? We were expecting some movement this week. I was all excited for a good trade, but got nothing but a snooze fest. Maybe we're waiting for next week's non-farm payroll. The first Friday of every single month is non-farm payroll, and that is always a catalyst for movement. So we might not be getting that movement right now, but now we focus on next Friday that we do have a big catalyst event, a reason for movement. So the 4 topics today, we'll talk about the Qs, we'll talk about NVIDIA, we'll talk about non-farm payroll, and then there's a really cool example of why we look at divergences. Divergences are trading correlations. Nothing is ever inexpensive alone. Something can only be inexpensive relative to something that's expensive. Okay? Otherwise, if you don't have something expensive and you just buy, you become what we call a garbage collector. We don't want to be a garbage collector. So therefore, we don't just buy because things are lower. We always want to do something relative to something else. Let's go over to the slide deck. Looking forward to this one. Ooh, big announcement. Look at my hands. Ooh, big announcement. Monday, school's closed. Labor Day. Enjoy the long weekend. There's not going to be a Masters in Trading Live because I'm going to spend some time and enjoy Labor Day with my beautiful family. Now we go to the slide deck. There we go. Okay, a little overview because this is a topic that we talk about often. It's so important, and I really would like everyone who's listening to make sure that you're following the vol curve. So this is VIX term structure. Most people will just watch the VIX. The VIX is a 30-day measurement of expectations for the market. So when the VIX is 20, there's a lot more risk in the market. When the VIX is 12.85, there's not a lot of risk in the market. So this is bullish. And this here is bearish. Okay? Why? It's the expectation of movement. What is real? What is the risk going on in the market? When the risk is low, markets trade higher. When the risk is high, markets trade lower. And that's why we use VIX term structure. Extremely powerful. So let's talk about the VIX 9D. A 9-day measure of volatility. Okay? What is going on? Well, this is a 1 hour, and this is yesterday's trade behavior. That's really sloppy, JR. Come on. This is yesterday's trade behavior after, once the market opened, it has the videos releasing. Notice how that 9-day just traded lower all day? Well, that made me think, and this is from yesterday. Yesterday afternoon, I sent this in Discord. I said, guys, this is a good example of the market being down, but I don't know if it's weak, right? The market was selling off yesterday, but if you look at the VIX 9D, the VIX 1 day, everything is just so weak. So what I also posted, guys, it may get weaker, but as of right now, the Qs are trading lower, but I don't think there's a heck of a lot of risk. Let's use 15 as our line in the sand. So let's stare at this number and say, anything under 15 is going to be weak. Well, that was yesterday afternoon. It's not surprising that the Qs gapped up this morning. They went right back to our crucial line in the sand. 475 remains our line in the sand. Above bullish, below bearish. Let me just pull up the Qs right now, because it has been a very, very tricky trade up here. What you don't want to do, and I also just posted this in the Discord, is the market will move when the market is ready to move. You can't just, you get so frustrated that nothing's really moving. Look at this, guys. 475 is that line in the sand. And when we say that line in the sand is above bullish, below bearish, well, we just take this off so you can see it more clearly. Once in a while, guys, you have to be honest and say, you know what? What's going on? The market tried to get above that, fine. Didn't follow through. Now it's under. We got to see if it follows through. 470 is going to be some support, okay? Use that 475. There's nothing going on right now. It's okay to wait and see, okay? Too many put on trades and need something to happen. Nothing has to happen. The market will move when the market's ready to move. Let's talk about divergence. Well, actually, I want to pull up Qs, because Qs, NVIDIA is going to be the same thing as the Qs. NVIDIA is running the show. NVIDIA is not that weak. It's not that weak, okay? I've always thought that markets have an expectation of drop. On bad news, the market's expected to drop, but if the market can't fall, it's going higher, okay? Bullish the market as long as that VIX 9 days stays under that 15. I love this example. This is a divergence trade. Okay, please follow along with this example, because I think that whenever you're risking money in the market, if you want to increase your probability of success, use divergence. It is so freaking powerful. And here's the example. On June 03, I shared this chart. If you go to YouTube, guys, and watch MIT Live from June 03, just search Jonathan Rose. Jonathan Rose on YouTube. 0603, we talked about a divergence, and the divergence was in Delta, American, and United. Correlated airline companies. Okay? At the time, we went back 5 years, and Delta was down 10% on the chart. American was down 64%, and United was down 39%. And we said that there was a disconnect. In the past, these have always traded together. Once in a while, they run away from one another, but over time, divergences come back. Why? Because they're correlated. They're in the same industry. If Delta and United go up 100%, do we think American Airlines is going to follow? Probably, right? Or there's an accounting problem and they're going out of business. But most likely, they're going to follow. They're the big airline carriers in the US. But that doesn't mean they're going to always go higher, because look, 2 months later, Delta, which was down 9%, is now down 28%. So in that time, Delta fell 20%. Look at the cheapest one, American. American at the time was down almost 65%. American is up relative to the other two. United, same thing, right? United is down. So the trade, look for divergences. This allows you to be bullish and bearish. And instead of just speculating on the direction of airlines, you're noticing a breakdown like that. And that breakdown is what presents that opportunity. So we share divergences trades in our divergence program, but this is just a great example of watching stocks come together. A little highlight on our earnings tool. Bill, I love this comment. Thank you so much for sharing. The earnings tool is the greatest invention since somebody figured out how to slice bread. Now, this is up for argument. I happen to agree with Bill here. Others may say, you know what? There have been a few other inventions since the invention of sliced bread. We'll leave that to you guys to argue on your own. Bill, I agree with you. Michael grabbed Irene as well. Irene, great job. Good trade. Let me get on live before I move to All Access. In All Access, I got a wing dinger of a trade for you guys. Everybody else, have a lovely weekend. No school on Monday. Markets closed. We'll be back on Tuesday, 11 o'clock Eastern. If you're out there, if you have any questions, you can leave them under the YouTube video, under those comments. I'll make sure I get to each one of your questions. Everybody in All Access, you guys don't go anywhere. I got a trade for you. Stay tuned.